Ever wondered how to truly compare investments? It's not enough to just look at how much money you've made. A hot stock might deliver huge returns, but if it kept you up at night worrying, was it really worth it? That's where the Sharpe ratio comes in. It's a powerful tool that helps investors understand risk-adjusted return. Essentially, how much reward you're getting for the amount of risk you're taking. For many Americans, thinking about retirement, saving for a home, or just growing wealth, understanding risk and return is crucial. We're often bombarded with promises of high returns, but rarely do we see a clear picture of the risk involved. The Sharpe ratio cuts through the noise. So what is the Sharpe ratio? In its simplest form, it measures the excess return per unit of total risk. Let's break that down. Excess return is the return you get above the risk-free rate. That's usually considered the return you'd get from a very safe investment like a U.S. Treasury bill. The total risk is measured by standard deviation, which basically tells you how much an investment's returns fluctuate. Higher standard deviation means higher volatility, and therefore higher risk. The formula looks a little scary at first, but don't let it intimidate you. It's Sharpe ratio equals return of investment, risk-free rate, standard deviation. Let's look at an example. Imagine you have two investment options, Stock A and Stock B. Stock A returns 10% per year and Stock B returns 12% per year. On the surface, Stock B looks better, right? But let's add some risk. Stock A has a standard deviation of 5%, meaning its returns fluctuate relatively little. Stock B, however, has a standard deviation of 15%. Let's assume the risk-free rate is 2%. Let's calculate the Sharpe ratio for each. For Stock A, 10% 2%/5% equals 1.6. For Stock B, 12% 2%/15% equals 0.67. What does this tell us? Despite Stock B having a higher total return, Stock A has a higher Sharpe ratio. This means you're getting more return for each unit of risk you're taking with Stock A. In other words, it's a more efficient investment. Think of it like this. Imagine two hikers climbing a mountain. Both reach the peak, but one takes a smooth, well-maintained trail while the other scrambles up a steep, rocky face. Both reach the same height, the return, but one experienced a lot more risk, the challenging terrain. The Sharpe ratio helps us identify which hiker or which investment gave us more bang for our buck, considering the difficulty. Now, how do you interpret the Sharpe ratio number itself? Generally, less than 1 is considered poor, 1 to 2 is considered good, 2 to 3 is considered very good, and anything above 3 is considered excellent. But these are just guidelines. The interpretation can vary depending on the investment type and the investor's risk tolerance. It's important to note that the Sharpe ratio isn't perfect. It relies on historical data, and past performance is never a guarantee of future results. It also assumes that returns are normally distributed, which isn't always the case, especially with things like options or alternative investments. It's also less useful when comparing investments with vastly different risk profiles. For example, comparing a stable bond fund to a volatile growth stock. For the average U.S. investor, the Sharpe ratio is a valuable tool for portfolio analysis. When you're evaluating mutual funds, ETFs, or even individual stocks, look for the Sharpe ratio alongside other metrics like return and expense ratios. Many financial websites and brokerage platforms now provide Sharpe ratio data. Let's consider a simple portfolio example. You're deciding between two portfolios, Portfolio X and Portfolio Y. Portfolio X has an average annual return of 8% with a standard deviation of 10%. Portfolio Y has an average annual return of 10% with a standard deviation of 15%. Assuming a risk-free rate of 2%, let's calculate their Sharpe ratios. Portfolio X, 8% 2%/10% equals 0.6. Portfolio Y, 10% 2%/15% equals 0.53. Even though Portfolio Y has a higher return, Portfolio X has a slightly better Sharpe ratio. This suggests that Portfolio X offers a better risk-adjusted return. So to recap, the Sharpe ratio helps you evaluate investments by measuring risk-adjusted return. It's calculated by subtracting the risk-free rate from the investment's return and then dividing by the investment's standard deviation. A higher Sharpe ratio indicates a better risk-adjusted return. It's a powerful tool for comparing investments, but it's not a magic bullet. Always consider it alongside other factors and your own personal financial goals. Remember, this information is for educational purposes only and should not be taken as financial advice. Always consult with a qualified financial professional before making investment decisions.